Ladies and gentlemen, my name is David Tam. I'm the Chair of the Funds Commission. Welcome to the September 5th, 2024 meeting of the City of San Diego Funds Commission. We're going to do a quick roll call to confirm Commissioner attendance. When I call your name, please say present. Commissioner John Peel, present. Commissioner Colin Dowd, present. And thank you. Your attendance has been noted. For the record, we do have a quorum consisting of Commissioner John Peel and Commissioner Colin Dowd and myself, Funds Commission Chair David Tam. Also present are David Paul, Deputy City Attorney, Allison Bonney from Northern Trust, Jeff Knipp from Siegel Markle Advisors, Travis Rigo as well, and Jeremy Shortis, Office of Boards and Commissions Liaison. We'll start with the approval of the minutes for May 23rd, 2024 Funds Commission meeting. Are there any changes to the minutes that were provided? Hearing none. Is there a motion to approve the May 23rd, 2024 meeting minutes?
Motion to approve.
We have a motion by John Peel and a second.
Second.
Perfect. Second by Commissioner Colin Dowd. To approve, we will now take roll call to count the vote. Commissioner Peel?
Aye.
Commissioner Dowd?
Aye.
And myself, I vote aye. That motion passes unanimously. We'll move on to the agenda. We'll start with the informational items, starting with item 1, report from Northern Trust regarding Mount Hope Cemetery Fund investment and performance review. I will hand it over to Allison Bonney from Northern Trust to present this item.
Good afternoon, everyone. Thank you, Chairman. Let me share my screen here, and please confirm that you can see it.
Yes.
Okay, and should I enlarge it a bit? Let me see if I can do this on my screen. Okay, so I'm going to do a very brief sort of executive summary and just then give you a perspective on what's going on today, since we've seen a lot of recent volatility in the markets. I'll give you our point of view on what's happening right now, and then open it up to questions. So this is a quarter ending June. Obviously, we're now in September. So some things have changed, but some things haven't really changed in terms of directionally. We would say that the trends are our friends right now. Just so you know, the equity markets through mid-year, pretty stellar performance. You saw S&P up 15. That's actually where it is today. Both developed markets and emerging markets outside the U.S. Doing well. We do know that a lot of what the return that we're seeing is coming out of the S&P, and specifically what is known as the Magnificent Seven, which averaged a return of 40% through June. And obviously large cap and tech led small cap, and growth led value by about a 15% spread. So growth is the story, AI tech is the story, and we've seen a little bumpiness. I'll come back to that this September, to be expected. But in terms of trends, all the inflation indicators are showing signs of normalizing. Clearly, there's discussion about, well, what would the Fed, where does inflation need to be long term? But, is it going to be 2%? Should it be 2.5% in the future? That's up for debate, but clearly the Fed is positioned now to be making cuts, primarily because of some of the softness we've now seen in the employment numbers. Job openings are decreasing, and that's a bad thing, but it's a good thing in terms of the Fed now starting to loosen the purse strings. We are in the soft landing camp, meaning that we would expect in September, and basically Powell said this, we are in the 50 basis point cut group between now and the end of the year. There are some naysayers, I will say, in the market right now who are saying the way things are setting up, and when you look at some various indicators that might, technical indicators that might imply that actually growth is slowing much more quickly, inflation will not go away, and therefore we are heading into a recession. That is not our base case. There's nothing out there on the horizon that tells us that there are any bubbles, other than frankly the tech stocks, which are adjusting themselves as we're moving along here, that would give reason for pause. So in summary here, and I'll go to your numbers, we have increased our expectations for global growth and corporate earnings sort of above consensus estimates. And we would expect all of the, let's say, non-MAG earnings to match what the Magnificent Seven did in year to date, but to match it in the fourth quarter, perhaps up as much as 17%. So what we're seeing is a broadening out of other non-MAG 7 companies. And I have a slide in here that I will talk about more in terms of the differentials. We think the yield on the 10-year probably is about at fair value right now. We've neutralized our duration positions. What does that mean? It means that the 10-year aggregate bond index, which is your benchmark, that's your bogey. The duration on that right now is about 6 years. Okay. We've been managing duration around that, understanding that we still have some variability in where rates will end up. The 10-year yield, I think today is at around 3.75. We think we'll probably end up between 3.75 and 4.5 when all things settle out, but it's going to take some time. And so we've got a little bit of short duration in the portfolio. We've actually added a little bit of longer duration as well. So we're hedging our bets, but overall we're at a normal duration, normalized duration. In terms of our positioning of portfolios, we continue, as I said, in a soft landing environment. We have been tactically overweight risk assets, both for global equities and high yield, and we're taking them from your investment grade fixed income and natural resource allocations. This is a quick chart that shows you what happened in April, May, and June in terms of the markets and the various events. And then clearly in June, it was the trends that seemed to be moving in the right direction that led to this rally that we saw at the end of the second quarter. In terms of actual numbers, let me ground you here. And I've learned recently, can you see my pointer? You cannot. I've learned that when I do Zoom calls like this, nobody sees my pointer, so I'm always doing talking through numbers, but let me guide you through verbally. So the year to date through June, we saw investment grade bonds actually slightly negative. What you're seeing in the investment grade market is all price appreciation or depreciation. That investment grade bond number right now, year to date through yesterday, I wrote these numbers down. And where did I put those? Hold on. Is up about 1.7. Okay, so that's yield. Okay. And again, prices are plus and minus, but right now we've got a positive return of 1.7 in investment grade bonds. In high yield, that number is closer to 5.5% right now. The high yield market year to date, 2.6. Now we're at 5, and that's a reflection of the positive spreads. The spreads have gapped in, but we're still very constructive on high yield bonds, given the fundamentals. Over on your equities side, year to date, U.S. equities through June were up 13.6. Actually, in August, at the end of August, they were up as almost to 20. They were at 19.5. We saw the backup this week. The S&P now, in the reflection of U.S. equities overall, is around 15.5. And we saw developed markets and emerging markets also excel. I think the last number I saw for emerging markets are up around 12%. Developed markets outside the U.S., 12%. And the emerging markets number is about 9.5%. So you saw developed markets catch up in the recent month. And global real estate, I don't know the number on global real estate now, but I would suspect it might be about flat right now with the expectation that rates will be coming down. So that sort of helps you understand your numbers, but I'm not going to go through a lot of these. It's old news, but PMI numbers coming down, that's positive, now back up. We've seen rates start to commence around the globe, rate cuts, excuse me. We've seen volatility pick up as we would expect. We had elections, if you recall, in India, Mexico, and France, which could have, created more turmoil than they actually did. At the end of the day, all the markets seem to have recovered, despite some of the contention regarding the conservative parties versus the liberals. And the slide in the lower right-hand corner is just showing you the relative performance of the S&P versus the equal weighted S&P, meaning that the S&P versus the Russell 3000, what is showing here. All right, interest rates, again, expectation that the yield curve is now going to invert. It's going to take a while though. Credit markets seem to be strong, and you see over in the lower left-hand corner how equities performed and how real assets performed on the right-hand side. So here is your portfolio as of June 30th. And I think the value, when I was looking, it's up slightly, but you'll see the positioning. So the first column is your target in your policy statement. So again, this is a conservatively positioned portfolio, which in the nearer term now is benefiting from finally getting some positive returns, real returns out of your fixed income. In terms of your risk assets, we're actually overweight your risk assets a total of 11% right now. It's within range. Everything is within ranges though, and it's 5% of that is coming from core equities, of which 3% overweight in U.S. equities, and then developed and emerging markets about 1% overweight to each. And you can see we did make some of these changes since in March. So this was second quarter, and then we've been making these additions. This was second quarter changes. We took it from real assets. We've reduced natural resources, and we've added to high yield bonds. So that's a pretty significant overweight. We're within range at 7%. So that is how the portfolio is positioned, consistent with Northern's point of view. And as I said earlier, we're taking it from core investment grade, TIPS, and some cash. Okay, so that's the current positioning, and this positioning has not really changed. We've seen some volatility in the markets, but we have not felt a need to go in and rebalance. The only thing we have been doing is changing the complexion of your fixed income a little bit to move it more to a neutral position. Here are the actual returns by asset class. So you can see year to date, your equity's up 8.5. This is through June though, remember. And you can see how large cap US equities have been the winners on a 1-year basis. They were at 19. I think on a 1-year basis today, over 12 months, it's probably at about 25. So pretty amazing returns. If you go down below, your year-to-date number through June is 2.7%. So that 2.9 versus a 2.7, the difference there is Northern Trust fee, advisory fee. The 2.9 or the 3% is net of all of the underlying fund fees. So the only difference between the gross and the net, remember, is the advisory fee to Northern Trust. On a 1-year basis, you're running at about 7.8% gross, 7.3 net. If we go out 5 and 10 years, your portfolio is running at about, or even since inception, 5%, 4.5%, and that's how the portfolio is designed. So if we were to go back to 2001 and look at your policy statement, that's how it was positioned, and it has been delivering on that accord. Okay, I'll just do a few more slide pages here, and then I'll go to Q&A. This is going to give you the detail of the funds that you're in. Okay, and sometimes we do change them around. But you can see here how your large cap is doing. Russell, you've got a DFA fund in here. So we will sometimes move the funds around, but it's a relatively very passive, low-cost portfolio. Here's your fixed income. And you'll notice if you look at the total of 48% in fixed income, we've got almost 20% now in the Barclays Ag Index. Okay, so that's where I'm saying we're neutral. DoubleLine is a sort of what we call a core plus fund manager. You can see their returns. So sort of pretty closely matching the Barclays Ag, which for the month was 95 basis points. year to date through June, as you saw earlier, -7. And then we've got you in TIPS, which since you've been in it has been negative, but more recently they held up at least on a 1-year basis. And then you have some individual bonds in the portfolio. Here you can see how your high yield did down at the bottom of the page. So you have 2 funds in the portfolio. You've got this HYGV. We'd like to have 2 high yield managers in the portfolio just for slight quality differences. And so you can see here how they performed. So on a 1-year basis, basically your high yield has delivered 9.5%. That's a 12-month number, which is great. And there you're seeing the spread. And year to date through June, you're at 2.5. Just a few more things, and then I'll stop for questions. And these slides are in the packet that we sent out to you. They're in a write-up in the back of the book or the slide deck. But obviously what we're looking to see is, unlike 2022 when we saw high correlation between fixed equity and fixed income returns, really the purpose of fixed income in your portfolio is the ballast. So we don't want to see high correlations, and that's moving in the right direction now. In terms of consensus expectations for growth in the U.S., 2024 is the number we expect growth, the green line, to be coming down in 2025. And similar trends globally. Here's just some information I mentioned about labor. We have seen softening. These are some of the numbers that frankly everybody is tracking right now, and it's very sensitive. There's a lot of different ways of slicing and dicing the employment data right now. But as I said earlier, the trends seem to be moving in the right direction in terms of softening, but not so soft as to, create concern regarding a recession. This is an interesting page here that's looking at, these are actually TSA throughput numbers. Now, this was clearly the summer. This is post-COVID where TSA picked up, travel. The numbers are even higher so far through the end of the summer. They may be coming down slightly just because of the seasonality, but that's a key indication of at least the consumer, who's flying. A lot of people are flying now. There is some concern that, credit card debt, particularly in the lower income brackets, is increasing, which could have an impact on consumption coming out in the third and now fourth quarter numbers. So those are other issues that are sort of on the table in terms of, okay, there's no more slush fund from the post-COVID giveaways. Interest rates are still high, so they're definitely a stress on consumers, but we haven't seen too much of it so far. And then finally, credit markets. This is the blip that we saw. Obviously, this is COVID. And the credit markets are pretty tight in terms of spreads right now and sort of where they should be. I talked about the equity markets. This is interesting, and this will underscore what's been going on in U.S. equities. This is showing you valuations in terms of price to forward earnings multiples. So for the U.S., for example, the median is about 17 or 18% multiple. Currently, and this was as of when this was, I think we updated these. This was as of, I guess this would have been through, these are through, only through 6/30. Okay. This has come down a little bit, and you can see globally though, everybody else seems to be within range except the U.S. Why? And here is the story. The green line is the S&P 500, which I was showing you earlier, which just S&P top 500, and the multiple is 21. The blue line is where the Mag 7 were. They're 30 multiple, and so that's sort of the green is showing you if you were to look at the S&P and pull out the Magnificent 7, you actually are at the long-term median for U.S. equities. So it's not. So I would say what we're seeing right now and the softness we've seen in in September is sort of to be expected if you look at, how much of a run-up we had in equities of roughly 9% in the S&P during the second and into the third quarter. So we are anticipating continued volatility going forward, and it is going to be very data dependent and to a certain extent geopolitical as well. Okay. In terms of our point of view on the elections, we're going to be publishing. I'm going to something next week, actually, in Chicago, and there's going to be seeing some of our most current expectations. I think a lot of it is dependent on where Harris versus Trump come out on their economic programs. Everybody's looking for more detail. Suffice it to say, I think the things that we are tracking from a longer term perspective is taxes. Okay, so tariffs. We've got them, but where does Trump want to go with that? How much more? What could that mean in terms of cost of goods in the U.S.? So again, inflationary expectations from tariffs, as well as immigration. Whatever, regardless of one's position, immigration does help in terms of job openings and and lowers pressure on wage growth, for better or for worse. So if we see, a clamp down, the way, for example, the Republican Party is suggesting exporting all these people, that could have an impact. So those are the areas that we're looking at, but I'll have more information to distribute to the extent we have a point of view one way or the other. I think right now we're actually pretty neutral because it doesn't appear anything that can get done will take a while to happen. Okay. So I will stop there and open it up to questions.
Okay, are there any questions or comments from the commissioners or staff or? I have one. As far as value versus growth, since we've had outperformance from the growth sector, are we looking at rotating more to value soon?
Oh, I wish I had the right answer to that. That's another thing I'm going to be looking at. We, in terms of value factors versus growth, let's go back to your portfolio and what's in it. So right now you are in, very neutral in U.S. So we don't have DFA, just so you know, has a slight value tilt. And that's why, but it's only 2% of the portfolio.
Right.
I don't know if you know Dimensional. But, you can see how they're lagging their index, right? The Russell 2000. So we've got some value exposure in your small cap, which is where we would want it. And we also have small exposure. I do not anticipate right now within large cap that we will be rotating anytime soon. But that could change. If I were to add anything, it could actually be non-US where we do see value tend to outperform. Okay. But again, we've got DFA in your international developed, which will have a value tilt. But again, they're lagging right now. We put that in the portfolio the beginning of the year, again, wanting to add a little bit of value into the portfolio. And you've also got it in your emerging markets, DFA. Okay, so you do have it in your non-US exposure.
Right, but only 2%.
Yeah. Well, and then in international, you've got 4% on the DFA,
Okay.
emerging markets value.
With the
Okay.
valuations of U.S. equities, why are we 11% over our target for risk assets? Why aren't we drawing that down?
Okay. So where it's coming from, if we go back, your 11%, 7 of that is coming from high yield exposure. So if you're asking me the 5% in core equities, that's where we want to be right now. We still want to maintain an overweight to U.S. to your equities and your high yield exposure. This is a better risk adjusted and high yield return expectation perhaps than in core equities, which is why we're as much overweight in high yield bonds. They don't, basically they're not as highly correlated with the equity market. So we're softening the blow with corrections. if we have a correction, your high yield will hold up better.
So we are at the max end of the range for high yield. If we were to
You're
go,
at 7 versus 10, right? Oh, excuse me, 10, right? I
We're at
apologize,
10.
right?
would it be wise to consider reducing exposure to lower credit quality bonds at this stage, looking at valuations in general?
Yeah, and that is something that we look at, you know, with our fixed income team in terms of quality. But you make a good point. Right now, the spreads on the lower quality seem to be holding. They're actually obviously more attractive, but in terms of the blend, we'll go back and look. But I think the blend that we have actually balances out the two. But you raise a good point, and we're always looking at that from a manager perspective. How are they doing, and will they hold up?
Okay. And then what was the reason for reducing risk control by 1.2 over there at the bottom? Over March 2024, bottom right?
Yeah.
Because we're
10th
already on the low.
March. Right. Well, that's what would have happened. Remember, because we added, actually, these numbers, this is strange. These should add up, but this could have been, let me audit these numbers again. I mean, where we are, if we reduced it, this is what we just took more out. We just took, but they should, let's see, 2, 6. Yeah, these numbers should add up to -2, 3, 4. This is wrong. That 1.2 is wrong. So let me go back. Let me correct that number.
Okay.
Okay.
And then as far as tips, do we still think it's appropriate with inflation reaching the Fed target, almost reaching the target?
Yeah, we have it there as a hedge,
Okay.
frankly.
All right. Are there any other questions?
I just wanted to clarify your base case for the federal funds rate. It says 25 basis points, but I think you mentioned 50 total. Is that?
Yeah, 2 cuts this year.
2 cuts this year. Okay.
Yeah.
Thank you.
Sure.
Allison, I just had a question on portfolio yield, and if you see any variance going forward to portfolio net income with the expected change in rates and some of your shifted positions.
Well, yeah, absolutely. I mean, rates may be coming down, but your share, I'll look at what your yield is, but overall, it has been going up. Okay, so if we shorten duration, you're getting slightly higher yield because, I mean, on your cash, you're getting 5% right now annualized. That will change, that will come down, but that's why we're moving you out in terms of your duration so that you can lock in the 4 wherever the 10-year ends up is where your yield should be longer term, and then we're going to layer on between 2 and 3% on top of that for your high yield exposure. So yes, your income will change.
With rates where they are currently, would it be wise to lock in individual core fixed income instead of going into funds with variable yields, since we know what our yield requirement is for the cemetery fund? A lot of core fixed income is at our target. So why not fix some of these instead of go into the Barclay Ag, for example?
Well, the Barclay Ag are you suggesting that you want to go beyond the Barclay Ag?
I'm suggesting individual securities, individual bonds.
Yeah, in this portfolio, we don't manage a sort of a laddered portfolio. But ultimately, if you look at it right now, okay, so you've got 7 million, of which 48% is being, okay, so your core fixed income, that's independent of high yield, so that's 48%. For us, that seems like actually, let me just go back here. This is what we need to look at. Pardon me. Okay, so the 19% is the ag. both of these are sort of hugging, the ag, the 6-year yield. Okay. We've got a little bit of tips. And the only other thing that we've got here, we actually have a longer duration. LQD is a longer duration. So that's what I'm saying. It's sort of a little bit of a barbell approach. Ravi, we probably reduced this. This is a floating rate. And, sometimes it helps, sometimes it hurts. But overall, it has helped during this period. So, but what we're doing on the margin is we might peel away a little bit more from Ravi and add it to the ag and keep a little bit of LQD in there, which is basically your longer term investment grade bonds.
Yes, but our yield is not as good as if we just go out there and buy government agencies individually.
Okay. Yeah, no, but your yield is going so good because you're saying you want to buy a laddered portfolio of
just individual
government agencies right now.
Government agencies, treasuries, core
Right.
fixed income, individual corporates.
Your yield, I can run the yield analysis for you. It's going to be pretty close to the same because of what you've got in the ag and LQD. Again, for this kind of a portfolio, we're not going to trade individual bonds. I do know on the private wealth side, people have just been buying treasuries, but actually they're stopping that now. They're actually trying to just go out and buy, you're right, longer term yields. And to us, that's the same as buying into the ag itself. But let me come back to you, Commissioner, on that question, just so you're comfortable with the overall yield and how it's positioned.
Okay. And would you forward that to Jeremy and he can forward it to the entire commission?
Yeah.
Perfect. All right. Any other questions? Thank you for the update, Ms. Bonnie.
Sure. Thank you.
So note for the record, this is an informational item. There will be no commission action. We will now take up items 2, 3, and 4 together. Item 2, report from Siegel Marco Advisors regarding business and economic outlook.
Sorry, Commissioner, I don't mean to be a pain, but we do for Brown Act have to ask if there's any public comment. I know there's nobody on the line, but for each action item, we do have to ask if there's public comment. I know that is highly unlikely since we're the only people here, but just for purposes of the minutes, we do need to make sure we give an opportunity in case anybody signed in while we were not otherwise paying attention.
Are there any questions from the public or comments? Hearing none. We will now take up items 2, 3, and 4 together. Item 2, report from Siegel Marco Advisors regarding business and economic outlook. Item 3, report from Siegel Marco Advisors regarding the performance of the funds. Item 4, Siegel Marco rating change for Western Asset Management. I'll turn it over to you, Mr. Nip.
Thank you. Jeremy, I'm going to start on 69 in the packet. Yeah. So Allison, as usual, gave a good review of what's been going on in the markets, including what's happened since the end of the second quarter. As with her, all of what I'm showing you here is as of June 30th. But I did just want to highlight a couple things. So we talked about the growth versus value and large versus small. But if you look in the year-to-date column up there at the top, I mean, you really see it. 20% for 1,000 growth, 6% for 1,000 value, and small cap, and this impacts your portfolio, up 4 for 2,000 growth, negative slightly for 2,000 value. So a huge difference between large and small, but also a consistent difference between growth and value. And it doesn't show up here, but part of what's been going on, especially in the smaller part of the market, has been the companies without earnings that have been dominating performance. Again, that started to change in the last couple of months, but up through June, it was just kind of junk rally, as it's called. And that's going to impact the relative performance that we're going to see in a minute. So I did just want to point that out. And then, Jeremy, if you can skip ahead a couple pages to the yield curve. I think it's maybe 3 pages further on. Yeah. Oh, yeah. So again, Allison talked about this. So there are the yield curves in the upper right. The yellow line at the bottom is where we ended last year. The brown line in the middle is where we ended March. The green line is where we ended June. Now, this has changed a lot since then, but you can see in the second quarter, not a whole lot of movement, but the movement that there was in the kind of medium to longer term. The short term was very stable and still very inverted at the time. Again, this has started to change a lot with short rates coming down very sharply so far this quarter. So when we look at this picture next quarter, it'll be interesting to see where we end up. But with that, then the next page, and again, Allison talked about it, you can see, year to date through June, the aggregate index was down 0.7. Through August, it was up 3. So just give you an idea, kind of what's that, 4% performance in 2 months for a bond index, pretty remarkable. In what's happened in the last couple of months, and it's all because of these weak job reports that came out literally August 1st, and the markets reacted. Stock market didn't like it, kind of recovered through the rest of August. Hasn't liked the most recent readings so far this month, but the bond market, yields dropped like a rock, and that means prices went up very, very sharply. So this is Allison was talking about the diversification. This is not 2022 again. We're actually seeing some diversification out of the portfolio, which is good. And the fact that the stock market has broadened out in the last couple of months, I think is also healthy. Smaller stocks have outperformed. Larger at the end of August, it was almost double in again for July and August, short period of time, but kind of everything turned around after the end of June. So with that, let's skip ahead. Let's see. Yeah, so as usual, I'll just use this fund as an example. They're all positioned pretty similarly. All of them at the end of June were running a little bit overweight in U.S. equities, not surprising, and that's really coming from the large cap part of the equities, and underweight in fixed income. The underweights in fixed income ranged from like 2 to 4% across these 6 different funds, well within the ranges. With fixed income, especially given the weakness of the equity markets the last couple of days, fixed income is outperforming equities this quarter. So this underweight will have done a little bit of self-correction with fixed income outperforming. 3 of these 6 funds have quarterly distributions, so we always look to see what's overweight, and that's where we take the distributions from. We look at all of them. You'll recall that occasionally, once or twice a year, maybe we've done some rebalancing. We don't need to at this point, but we keep an eye on this, and always ready to make a recommendation on that if we need to. All right, and then a couple pages on, we've got performance. Last quarter, I think I mentioned every single portfolio that you have, except one, which was the Boston Trust Small Cap, had outperformed. Well, this quarter, every single portfolio you have, except one, which is the new Baird Bond Fund, underperformed. So, here we go, typical short-term market behavior. Your S&P index fund is tracking despite the red lines. It's doing exactly what it's supposed to. Boston Trust is underperforming down at the bottom of the page there, a couple percent during the quarter, about 1% year to date. This is that junk rally. They focus on companies with earnings and quality and that sort of thing. I can tell you that this quarter, I had Travis, who's my colleague, who's on, run some numbers through the end of August, and they're outperforming so far this quarter, which even though it's kind of a bull market for small caps, and this is a more defensive kind of conservative manager, the fact that the nature of returns has changed and quality actually matters and earnings actually matter is helping their relative performance this quarter. Long term, we've had them in place now for 3.5 years, done a great job. Next page, then we've got the international managers at the top, underperforming both in the quarter. Dodge & Cox, more of a value manager, the Euro Pacific Growth, more of a growth, not as growthy as Dodge & Cox is value-y, I use those terms, but both of them lagged in the quarter, not really surprising. The Euro Pacific funds still ahead year to date, and again, with numbers through August, they're still ahead year to date. Dodge & Cox has actually bounced back very nicely so far this quarter, outperforming. Again, value starting to do better in international markets as well. And then down at the bottom, the bond fund. So at the very bottom is the new Baird fund that went in place in March. So their first full quarter, they've outperformed a little bit. Western, not surprising, longer duration positioning. So with those rates, as I showed on the yield curves, especially the longer end rates rising, that didn't help them. Both those managers, I can tell you, this quarter are pretty much right on the benchmark. Again, up 3.5%, 4% in the first 2 months of the quarter. Western's long-term results, until you get out to the very long term, ugly. This is classic Western. They're either going to be really good or really bad, and we've seen this before, and that's partly why we put Baird in there, to get some better diversification. We used to have the MetWest fund, which was not really diversifying Western as much as we needed it to. So got one quarter now, but this is how it's supposed to work. That Baird is very different from Western, and so I think that's going to be a good combination going forward. So again, that's performance through June. Again, I had Travis run some, just in terms of absolute returns. I think you're probably, again, through August, so excluding the last couple of days, up about 4.5% this quarter through August, so July and August, and year to date up almost 11 in these portfolios. So pretty healthy. That will have come off somewhat given what's happened the last couple of days in the equity markets. But from performance wise, again, we saw a good quarter 2 quarters ago. We saw a bad quarter this quarter, but this is all very consistent with what these managers do and what the markets have been doing. And I was glad to see when I looked and like, okay, I would expect Boston Trust and Dodge & Cox to have outperformed this quarter. Sure enough, they are so far. So that's good to see. Any questions on performance before I get to more about Western?
Just a question on the non-US equity at 26.5% of the portfolio. How does that compare to what the policy range is? And do you feel that that might be overweight compared to US?
It's actually, if you think of it in terms of what the world portfolio would look like, it's actually underweight relative to the US. So the policy, Jeremy, actually, if you go back, page number, but it's kind of the first page in
Page 9 of the report, I think.
Yeah, just see the allocation of this one. Yeah, there we go.
Yeah.
So there you can see the policy targets and ranges. So US is 40%, international is 25%. So, that's compared to a world portfolio, that's a little bit overweight US actually. And then fixed income is the other 35%.
Okay.
This has been in place for a while. It was changed several years ago. I think just like by 5%. I think an additional 5% in fixed income. It used to be 70-30, now it's 65-35.
And I'm just curious as the new guy here, right? I mean, no matter what time frame you slice it, the Eurozone or non-US has underperformed. And
Yeah.
just a lot of the news and forecasting coming out of the Eurozone in particular just seems to pale in comparison to what we have here and what we've done post-COVID.
So much of that really is one thing, which is tech, which is huge US industry and not much elsewhere. I mean, you got a few scattered, Taiwan Semiconductor and a few things scattered around. And those have all done well too, but there just aren't that many of them. So when you've had this sort of concentrated sector performance, it's not surprising to see the international markets lag. Will that continue? I don't know. I can tell you that our long-term capital market assumptions expect greater returns from international than domestic over the next decade. Not by a huge amount, but I mean, Allison was talking about she showed the chart of valuations. US is off the chart at the top. Everything else is kind of in range, and that's really it. It's okay, yeah, these may be great companies, but what do you have to pay to get them? We've seen good old Nvidia the last couple of days take it on the chin. So I think there's kind of been this little dose of reality in the last couple of days, and we saw it again at the beginning of August. So I think that's healthy. What that's going to mean for U.S. versus non-U.S. Currency obviously factors into it. But if U.S. rates cut, that should, all else being equal, that should help foreign currencies look more attractive. So that'll boost the international returns.
How do we compare as far as other portfolios that you manage with a 26% international exposure?
That's pretty normal,
Yeah.
I would say. Yeah. 20 to 30 is pretty standard.
Okay.
And like the other ones all have more US than they do international. So it's just a question of how much. So. Other questions? Okay, the other issue then I want to talk about Western, which is one of the bond managers. And there's actually two parts to this. One was just closing the loop. I had sent an email at the last meeting. I had mentioned possibility of some commingled funds that maybe we could access with a lower fee. Turned out we couldn't, because they require $1 million in each individual account, which doesn't exist here. These portfolios just aren't big enough. Plus they have a delayed trading, which wouldn't work when we do the rebalancing and the fundraising. So I'd sent an email about that, and I just wanted to make sure we closed the loop. The other news with Western, and I included a memo from our research team, is just a couple of weeks ago, Western notified us, and I give them credit that they notified us before it was out in the press, that Ken Leach, their chief investment officer, had received a Wells notice from the SEC. And this is interesting. It wasn't the firm, it was Ken. And it's also interesting because the issue is not really at debate. It's not like the SEC is saying, oh, you did this, and Western saying, no, we didn't. What the SEC is focusing on is treasury derivative trades that were made, and then at the end of the day were allocated across different strategies. There was one strategy that Ken Leach pretty much ran. He was the portfolio manager. This was a sort of macro type strategy, no real benchmark. He also is part of the team as CIO, head of the team, running the core and core plus strategies. You have the core plus. That macro kind of unconstrained strategy, on days when there were sharp upward moves in treasury prices, in order to keep the portfolio characteristics the way they wanted them, that strategy would get a bigger allocation of those derivative trades that day. And they say, yeah, that's exactly what we did because we were trying to keep the portfolio position the way we wanted it. And because it's not tied to a benchmark where this portfolio is going to move along with the benchmark. And so our duration difference isn't going to vary that much. This portfolio doesn't have a benchmark really. So to keep the duration where we wanted, we had to allocate more of those trades to it. So the SEC is saying, oh, well, you benefited one strategy over these other two. And so again, there's not really a dispute about what they did. It's more a dispute about why they did it. And so Ken Leach has taken a leave of absence. He's got 30 days to respond to the SEC about this. It's going to be interesting because, again, they're not disputing what, they're disputing why. So we'll see how this plays out. It could take a while. But given this, in our research team, we have ratings on managers. Recommended is the highest rating, and that's what Western has been. There's also an approved rating, which is, yeah, they're okay, not our favorites. And then there's a hold, which is what we have now rated Western. And in this little 2-page memo, it explains why. In a sense, okay, your CIO was taking a leave of absence. That alone, forget anything else. No matter why he did, if he was sick or whatever, that's worth it right there. But then we've got this additional sort of regulatory oversight from the SEC, and what's that going to mean? What's that going to mean in terms of how do clients react? They're going to pull their money out. We haven't seen that. There've been a couple, but for the most part, I think most people are dealing with this on a wait and see basis. We think that's the right approach. If it turns out that something that bad was done, then I think we need to move on. This, especially with portfolios like this serving the purpose that they do. We don't want to be associated with something bad. Who knows how this is going to come out. We had a call, our research team had a call the very next day with Western. They went through all this in great detail with them. They're keeping us up to date on fund flows and client activity. Again, there hasn't been very much because I think most people are in this wait and see position. So wanted to let you know we put them on hold. This is not saying, oh, we need to get rid of them, but we're going to monitor it, see what happens, and if we decide actions called for, we will let you know. But it's an interesting one, and I prefer to be bored, not interested. But this is what we've got. So, any questions?
Yeah, to play devil's advocate here, why don't we just proactively move into a lateral position with another fund manager and wait till things play out, and that we still have confidence in them? We could reduce our new position and go back to Western.
So
we're not the ones holding the bag.
Right. Well,
if there's a mass exodus.
It's a very fair question. And the main reason I would say not to do that is the nature of Western's performance. That, as I was saying, they're kind of here or there. And there are other people who kind of, are sort of like that, but not really. And given where we are in their relative performance cycle, I kind of don't want to pull the plug right now because unless there was some other reason to do it. Because I think if we do that, even if we go to something else, we're not going to see, and especially if this drags on for a while, we're not going to see the other side of the Western performance. So it's not an unreasonable thing to do, but with the lack of kind of clear wrongdoing, I would say let's just sit tight.
Do we know what the net asset flow is on that particular fund in the last quarter?
Well, so this macro fund that he was running, they shut that down. Okay. And they shut it down because he's not there.
Yeah.
And that's why it was like a $2 billion fund. So they just said, no, we're not offering this product.
Yeah.
The core and core plus strategies, the more team oriented things, minimal cash flows that we're aware, and we're going to see, institutional clients, and this is an institutional manager. So there's been one or two public funds, and because they're public, that they said, okay, we're going to get out. But one of the things that our team has talked with Western about is, okay, make sure you're keeping us up to date with what's going on. We haven't seen big flows at this point. Yeah.
And have there been any team defections at all?
Not because of this, no. So everybody else that was there 2 weeks ago is still there. Yeah. And again, it really is the Wells notice from the SEC was to Ken, not to Western. Yeah. Which is another kind of interesting twist to this. And part of what's hard to understand is, well, why would he, if he's trying to advantage himself, why and how? I mean, he's managing all these strategies, and so that's one of the kind of mysterious parts to this is kind of motive, if you want to call it that. That if the SEC is thinking he did something wrong, well, why? So we'll get some more clarity over time. I think we're in the period right now. He's got his 30 days to respond, and then they'll go through their process that they go through.
How quickly can we pull out if we need to?
In a day. Okay. It's a mutual fund. So,
but you have the authority to do that. It doesn't need to be
Without action from us.
right. You guys would have to take action.
We would have to.
Right.
And we can do that without meeting.
I think we'd have to call a special meeting
If you have a special meeting, then it could be online or whatever.
with 24-hour notice.
Yes.
Yeah.
Okay.
Yeah, assuming you wanted to do it at like 1 moment's notice, not at a regularly scheduled meeting.
Mhm.
Or you can have a regularly scheduled meeting as long as you did it 72 hours in advance.
So basically 24 hours notice for the special meeting, make the decision, take a day to execute it, figure out where the money's going to go. Yeah, that's the
And I
other.
don't think we'll have to do that.
Yeah. Yeah, but yeah, and this is again, mutual fund, very liquid, huge asset base here. So
best case scenario, he returns from his LOA, maybe pays a fine. I mean, worst case scenario, he's barred.
yeah, so from my standpoint, worst case scenario is there was some sort of legal or compliance breakdown within the firm. And we've talked to them about their compliance. Was there, the way these trades were allocated, was something done wrong? No, this is, this is kind of what we've always done. So, we'll see how that plays out. That to me that's the red flag, is if there's something institutionally, maybe their processes should have been better. All right, but if there was wrongdoing for whatever reason, absolutely, let's just go on. Like I say, given that everybody seems to agree on what happened, it's just the motivation and was this somehow improper? That's why I think this may take a while to work out, because Western's going to make the case of, okay, this is how we manage this portfolio. I don't know.
And in the meantime, his deputies.
Right. So what had happened was a few months ago, Mike Buchanan had become co-CIO. So Ken's, approaching retirement age. There was nothing that said, oh, he's about to retire. So that had been done, but that was a clear indication of where this was headed, that eventually he would retire, Mike Buchanan would become sole CIO. Well, with Ken on leave of absence, Mike Buchanan is now sole CIO. If Ken comes back, we'll see. I don't know what they would do, but it sort of speeded up that process, basically.
Okay. Are there any other questions or comments from the general public? or commissioners or city attorney, city treasurer, or staff? No. All right, Mr. Knipp, thank you for providing the Funds Commission with this information. Note for the record that these are informational items. There will be no commission action. So action items, we have 0 action items before the commission today. We will now move on to the next item on the agenda. Non-agenda public comment. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction, but not on the agenda. This afternoon, we have 0 speaker slips turned in for non-agenda public comment. Jeremy.
And if I can just respond on that. So I did want to let the commission know that we were asked by the Rules Committee to present at the October 2nd session. I will be sending an email out to the entire commission, but for you, Chair Tam, and the advisors, Jeff and Allison. Just giving like a rundown of that, and that's on the morning of October 2nd.
Okay, I have a conflict that day, but I'm sure the treasurer or maybe.
Well, yeah, Liz has a conflict as well.
Oh, does she? John?
Well, it's in the morning. It'll typically be 9 o'clock, I believe, is when the session starts.
On the 2nd?
Yeah, October 2nd.
Yeah, I can.
Wonderful.
Thank
And it's
you.
just like, reading the slides, like we got the notes for you.
Yeah,
You're good.
I think I did last time.
You
Yeah.
did, thank you.
Okay, so I'll include you on that email, John.
Yeah, you did do it last time.
I did.
Yeah.
That was fun.
Yeah, and we may have council or committee member briefings as well, but I'll let you know.
All right, next on the agenda is scheduling the next meeting. Let's determine the availability for November. I prefer Thanksgiving. Let's see. Today's Thursday. So how's November 6th or 7th for everyone? Same time, 1:30.
7th doesn't work.
Okay, how's November 6th?
That's actually the city's DC plans meeting.
Oh,
So I and Liz will be in that one.
yeah, so there will be, how about November 13th? 1:30.
Wednesdays aren't good for me. What about the 12th?
Yes, that works for me. 1:30. November 12th.
Works for me.
I think we have a winner. November 12th at 1:30. So that will be the next Funds Commission meeting. This brings us to the end of our meeting. The next Funds Commission meeting is scheduled for November 12th at 1:30 p.m. Meeting adjourned at 2:34 p.m. Thank you. Good work.